Let's get in an important global voice as well very quickly before we start taking the closing strategies from all our experts. John Woods, CIO of Citi Private Bank, joins us right now on the show. Good having you. Thanks so much for joining in. Just a fundamental question of what should investors focus on more at this point? Is it a default risk in Europe or a growth which is slowing down in Asia?
Look, I think that the main focus at the moment is to be defensive. I don't think there are any awards at the moment for taking on risk appetite or risk exposure in the current time. You know, the global overlay is still quite risk averse, and to that extent we're recommending clients focus on yield, safe haven type assets such as fixed income, which we think will do very well in the next 6 to 12 months.
In March, you said that there would be a mild recession in Europe. Has that view changed given the news flow that you're seeing out of the region? What's the worst case scenario that you're working with on Europe, and what would be its overall impact on Asia then?
Well, yes, there is a mild recession going on in Europe, and I suspect that it will continue for some time, for as long as the austerity measures are being rolled out across particularly the southern periphery. What could go wrong, or what is the worst outlook? Well, obviously a disorderly and messy breakup of Greece, something that is not planned or prepared for effectively, something which impacts the banks and the underlying capital quality of these financial institutions across the Eurozone. Actually, the list is kind of endless. My sense is, however, that if Greece is allowed to exit, I would be surprised if there weren't some supportive policies to mitigate or offset, or at least contain some of the contagion effect that will probably happen as a consequence.
Right. The other question, John, is what's the mindset amongst investors? Is it flight to safety, or in certain pockets there is also a thought process of buying into the fall?
Yeah, there's an awful lot of risk aversion at the moment, and a focus on capital preservation. Clients at the moment are looking at the safest havens they can find, and in some instances, if that's cash, it's entirely understandable. There's a very marginal appetite for taking on risks at the current level, but I suspect as the market becomes more and more oversold, and perhaps as the risks of a Greek exit, A, get better understood, and B, get more priced in, perhaps we may see a little bit of speculative risk-taking coming back.
Right. Do you think June will perhaps give some good news for the market? Could we see the sell in May trade reverse over the next month or so?
Well, I don't think, and this is a difficult prediction to make, but I would be surprised if Greece exited before the elections, which are slated for mid-June. So I think that we'll continue to see something of a slow bleed in terms of risk assets until then. I could be wrong, but that is my view. Thereafter, I think it'll become a lot harder to call. If it seems very firmly that there is a Greek exit in the offing, then I would be surprised actually if we didn't see some sort of coordinated response by central banks in order to mitigate or offset the contagion effect. If that's the case, we could see a bid for risk assets in much the same way we saw during QE2 and the LTRO initiative.
What's your view, John, on how to view at the emerging markets at this point? And specifically, what's the view on India, given the macro concerns for the region?
Well, first of all, from an overlay perspective, as we all know, emerging markets are being particularly hard hit by the risk aversion in the Eurozone at the moment, and will continue to be hard hit for as long as there is a flight to safety and people want to unwind perhaps risky currencies or risky assets for the safety and value of the US dollar. That will continue. As I mentioned earlier, India also has a challenge in that it wants to attract inward investment, and it wants to make its own investment environment as compelling as it possibly can. You obviously have a fiscal challenge going on there. You have an inflation challenge that still needs to be resolved, and obviously you have the political will to offer and generate and open up attractive opportunities to investors. And until those three challenges are resolved, I suspect that interest and inflows will remain somewhat at diminished levels.